Hello everyone and welcome back to High Finance Graduate. In the next couple of videos we are going to take a look at the world of private equity, and I know there's a lot of buzz, there's a lot of interest around this topic, so I thought this will be a great time to cover it. We're going to take a look at the world of private equity, what it is, what private equity firms do, the difference between private equity and investment banking, the recruitment processes that you should go through in order to break into private equity. So whether if you're from an investment banking background, management consulting background, or whether you are from an industry, or whether you're a fresh graduate, how should you approach trying to break into private equity, from what works and what doesn't work. And then we're going to cover actual interview questions and answers, as well as LBO case studies, which you should prepare for in order to ace your private equity interviews and assessment centers. So if you haven't already subscribed, then you might want to consider subscribing so that you can be up to date whenever we release a new video. So let's get started with our first video of what is private equity. And I'm going to cover this from 5 perspectives. Number 1, what is private equity from a simple standpoint? Number 2, who uses or who invests in private equity firms? Number 3, the strategies which private equity firms uses in order to generate tremendous returns. Number 4, we're going to look at what exactly do private equity firms look for whenever they're trying to acquire a business. And finally, number 5, we are going to take a look at the different types of private equity firms out there. So let's begin with, what does a typical private equity firm do in the first place? And a simple answer to that would be, they buy private companies and then sell them later on for a profit. Okay. A much better answer would be to ask a better question, and that is, what makes private equity firms so special compared to other types of investment vehicles? And that is debt. Private equity firms uses a lot of debt in order to buy companies. And essentially they might put only 10 or 15% of their own capital, of their own money, and then they're going to borrow the 90 or 85% from a bank. Now you might be thinking to yourself, why would they use a lot of debt? Why would they use so much leverage? And the simple answer is, it tremendously magnifies their rate of return. So let's just take a look at a simple example. Let's just say you own a private equity firm and you currently have $100 million, and you invest that money into one company which is worth 100 million. Later on down the line you sell it for 120 million. So effectively, you've invested 100 million, you've made 120 million, that's a 20% rate of return. So now let's just introduce leverage or debt into the picture. So instead of putting in the whole 100 million, let's just say you only put in 20 million, and then you decide to borrow 80 million from a bank. But then later on down the line, you still sell the company for 120 million. So after you've paid back that 80 million, you're now left with 40 million, because remember, 20 million you had from the beginning, and then you've made an additional profit of 20 million. Now that's a 100% rate of return when you've used leverage. Now I know in reality there's a lot more things to consider, like debt repayment, interest payments, but this is just a simple example to introduce the fact that how profitable, how much it magnifies your rate of return whenever you use leverage. And this allows the private equity firms to do 2 things. Number 1, it allows them to intensify or magnify their rate of return. And number 2, they can now diversify their risk. So instead of putting in the whole 100 million in one company, they can now put in 10 million in 10 different companies and diversify their risk. And this is what makes private equity firms so special, the fact that they can use leverage effectively. So now let's move on to point number 2, and that is, who usually invests in private equity firms? And your typical investor profile for private equity investments include wealthy individuals, corporations, governments, schools, sovereign wealth funds, venture capital firms, asset management funds, even other private equity firms that want to diversify their exposure, so they would invest in other private equity funds. So what makes private equity so attractive to all these investors? Well, you probably guessed it. It's the high rate of return. But that's not the only thing which they look for whenever they're trying to invest their money. Let's just say, for example, you're a wealthy individual and you want to invest your money. And one way is to invest in publicly traded companies, stocks and shares. But the problem with that is you suffer from market correlation. If the overall market were to go up, then your shares, your portfolio, the value of it will also go up. and vice versa. If the market were to go down, then there is a high correlation that your stocks and shares, your portfolio will also go down. Now, one way to diversify away from that market-related risk is to invest in private companies, which private equity firms do very well. They invest especially in private companies. So you can now effectively diversify away from market correlation. And that's a very important component when it comes to investing in private equity, because it allows you to hedge your risk from market correlation. So now let's move on to the strategies which private equity firms use in order to generate this tremendous rate of return. And one of the most common strategy is what's known as a leverage buyout, or abbreviated as LBO. And this essentially was made famous back in the 1970s, and essentially it's when the private equity firm will use a lot of debt in order to take control over a company. Now, what's also interesting about this strategy is the fact that in our example, when the private equity firm only put up 20 million and then borrowed the 80 million from the bank, that 80 million was collateralized against the acquiring company's assets and balance sheet, not the private equity firm's assets and balance sheet. Now, this is very important, because what this essentially means is if the deal were to go south and if everything were to just break down, then at worst, the private equity firm will only lose the 20 million which they put up as the deposit, and the rest of the 80 million, well, then it will then go to the bank, because they will then take control of the company, of their balance sheet and assets in order to salvage whatever they can. So at most, all that the private equity firm can lose is just 20 million. That's it. Now, everyone in the world of high finance knows what an LBO is. And there are other strategies which private equity firms uses, and one of them is take private. And this is one of the strategies which we go through in our Excel financial modeling course. And the case scenario that we use is Dell. So essentially, if a private equity firm believes that by taking a public company private, so outside of the public view, outside of public scrutiny, and they believe that they can better run this company in the private eye under new and better management, and in order to increase its value, they will do that. And again, that's not buying a private company. Instead, they're doing the opposite. They're buying a public company. And there are a range of other strategies which private equity firms uses in order to generate return, from spin-offs, carve-outs, divestitures, consolidations, and you can pretty much check out all of these topics and processes in our private equity interview and recruitment guide. It's worth knowing, especially these are common questions during interviews. But more importantly than just knowing the actual strategies, it's more important for you to actually know the actual deal process, from identifying a takeover company, conducting due diligence, what kind of due diligence, how long to spend on due diligence, building a valuation model, building an LBO model, how to run channel checks so you make sure that from an industry perspective there is room for this company to grow and flourish, and how and when do you negotiate with investment bankers for financing and terms. You should ideally know all of this in order to stand out for your private equity interviews. And this is why here at High Finance Graduate we have compiled one of the most comprehensive private equity and VC recruitment guide, along with over 400 technical and behavioral interview questions and ideal answers so that you can stand out during your interviews. And we also cover hints, tips and techniques from industry veterans, from how they succeeded when they landed their private equity role, whether it's an analyst or an associate at some of the world's leading private equity firms. So definitely check that out if you are interested in breaking into private equity, as well as our Excel financial modeling course covering every type of valuation model, from a DCF model, comps, M&A model and LBO model, all in Excel, step by step. So now let's move on to what exactly do private equity firms look for whenever they want to take over a company. And the reality is there isn't this magical set of criteria that will guarantee success if you can tick all the boxes, because sometimes you might find a really attractive deal, but because the assumptions you are working with didn't materialize, because the market changes, that this superstar deal just turns out to be a dump. On the other hand, you might find a small company in the portfolio, but just happens to be the best performing company in the PE firm's portfolio. But that doesn't mean that private equity firms will just buy any company you throw at them. If you analyze a list of successful historical private equity deals, there are around 10 to 11 characteristics or traits of a successful company. And we are going to go through them in this video right now. The first criteria which private equity firms look for when they want to take over a company is finding a company with barriers to entry. So finding a company with brand recognition. And what essentially this means is, regardless of how many new competitors are to enter the market, the company with high brand recognition, they're going to be able to maintain its customer base, its margins, and maintain its market share. And this is very important because the worst thing that can happen to a private equity firm is if they are to spend a lot of cash on acquiring a business and within 2 days a new competitor enters the market and take away all of its clients and all of its market share. And finding a company with high brand recognition means that this company can charge premium prices. So not only are they able to charge higher margins, but they can use some of that profit in order to grow the operations and the company. Number 2 is finding a company with a relatively unlevered balance sheet. And what this means is that a company with not that much debt on it is going to be able to add additional debt. Because again, the way that an LBO works is that you're going to put debt on the company's balance sheet. But if you find a company with a tremendous amount of debt already, then additional debt might cripple the company's operations, or it might make debt repayment, debt refinancing so expensive that all of the company's free cash flow is essentially just going into just debt repayment, and you're not going to have anything to actually grow the business. So finding a company with a relatively unlevered balance sheet is great. Now, there is a caveat to this. There have historically been some companies with a lot of debt on the balance sheet, but they were still able to make a great profit out of it. But that's not the ideal situation. You want to find a company with pretty much zero debt or very little debt. So then you can add additional debt on the business, and the additional debt isn't going to cripple the operation. The third criteria is finding a company with stable cash flow. Predictable or stable cash flow essentially means that a large proportion of your clients or your revenue is reoccurring revenue, which is great. So there's not a lot of fluctuation when it comes to revenue, and the ability to pay back debt is much easier and much more clearer when it comes to modeling it in an LBO or when you're performing financial valuations. The second benefit is that when you have a company with strong reoccurring revenue, it means that this company is not going to be affected by macroeconomic shifts or political changes or pretty much a lot of the unpredictable events. Then finally, when it comes to negotiating financing terms, so when it comes to going to an investment bank, raising debt, and if you can show that the company which you're about to acquire has a stable and an upward trajectory when it comes to revenue, it's going to be great, because then the investment banks, they're going to see that this company will be able to make regular repayments, so therefore they can negotiate and there will be room to negotiate for favorable financing terms. So the deal can be closed with relatively good financing terms. The fourth criteria private equity firms look for when they are about to take over a company is concrete improvement opportunities. Now, before a PE firm is going to take over a company, they must first establish a plan by which will outline how they're going to generate a return from the deal. One of the ways they can generate a return is by improving the company's operations, so that later on down the line when they go to sell the business, it's worth a lot more, so they can get a return on their investment. And there are various ways private equity firms can increase the company's operations performance. And I go through a lot of this, or the team here goes through a lot of this in the private equity guide. And essentially some of the ways is by improving the company's infrastructure, either by improving the IT infrastructure, realigning employees' incentives, so you give employees equity share or bonuses if they meet certain targets, hiring better management team with more experience in the field. You can optimize the price and reduce cost in the business. You can do carve-outs and spin-offs and divestitures of less profitable entities of the business. And you can even consolidate some of the market participants by doing M&A activity. So essentially that's just buying out your competitors so that you can increase the overall market share. And again, if you want to see more of how this is done, you can pretty much check out the private equity interview and recruitment guide, where we pretty much go through all of this. Now let's move on to number 5, which is finding favorable deals. Now essentially, private equity firms do not want to overpay or overbid when it comes to finding an opportunity, especially if that opportunity was presented by an investment bank. So if an investment bank is representing a client who wants to sell their business, they can go to a private equity firm. Now, you can pretty much be sure that this investment bank is not just going to go to just one private equity firm, but go to multiple and then choose the one with the highest bid. But essentially, private equity firms do not want to overbid or overpay, because then it makes it harder for them to justify the returns that they need because they've overpaid. So private equity firms never want to overpay or get into a bidding war. But if a private equity firm has the experience and the confidence in dealing with certain companies in a particular industry or in a particular type, say for example, if a private equity firm is really successful at turning around unprofitable solar companies, car manufacturing companies, then that might give them the confidence, because they have the experience, to overbid in those circumstances. But regardless, when it comes to building the financial model, private equity firms will always target a money on money multiple of 2x and an internal rate of return of 20, or whatever it is that they feel comfortable in generating or targeting. Now again, you can pretty much see this in the Excel financial modeling course, where we pretty much break things down as to how you build an LBO model. And again, if you do want to see other criterias, then do check out the interview guide, because otherwise this video is going to be a lot longer than what it already is. Okay, so in our next video, we are going to take a look at the actual recruitment process by which you should go through, whether you are a fresh university graduate, a B school graduate, an experienced investment banker in management consulting, or within the industry. And if you're trying to pivot into private equity, how should you go about it? We're going to talk about that in our next video, as well as we're going to make another video on private equity interview questions and answers, as well as how to build a basic LBO model. So be sure to subscribe so that you can be notified when those videos are released. I'll see you next time.